This is Nick Kristoff with the Kristoff team, and wanted to talk today a little bit more about construction loans and specifically the draw process. So we get a lot of questions about how the draw process works. That's after your construction loan is in place and as the funds are then being dispersed to go ahead and to build that project. How does it work? When do payments, how are they made? What amount are they made? So we get a lot of questions along those lines, and then how much are they? How do we figure that out? So I'm going to walk through a little bit of template to give you a ballpark. We'll use an example to do that. But big picture, basically, when the construction loan goes into effect, starting at that point, you're going to basically be either starting at zero if there's no lot loan or anything else to pay off, or whatever maybe the balance is of that lot loan that gets paid off. Or if it's the purchase of a lot, maybe the amount that's associated that will be used for the purchase of the lot. So you'll start there. For our example, we're going to start at zero. Just assume you own the lot and there's no loan on it, just to make the scenario simple. But through the construction process, then what we're going to look at is how does that balance grow over time as each draw is completed, as funds are being dispersed to pay for the build. And so that's what we're going to look at today. Basically, how does that process work? For a construction loan, you're paying interest only on the outstanding balance, only on the portion that's outstanding for that period of time. So you get a bill each month in the mail. You have a balance that was outstanding for however, maybe 15 days of the month. It was at 100,000, then it moved up to 150 for the last 15 days. That's how it's calculated. 15 days at 100, 15 days at 150. They add it up, and that's how the bill comes. So it's calculated just like that. Each month, you're going to get a new bill, and that balance will grow from, call it zero, to whatever your final loan amount is, or whatever amount that you wanted to borrow. So what we're going to look at is how that kind of looks in terms of numbers. They will vary based on your builder, your contract. Some builders have 6 draws. Maybe the project's smaller. Some have 12. So it'll vary a little bit. We're going to use an example with about 8 draws. So we'll kind of space them out and say, okay, what does that look like for each draw? How are the funds dispersed? So without further ado, let's jump into some of the numbers. So here's an example. I'm going to go ahead and zero out some of these numbers. This is just a template I had to use for the purpose of calculation. So what we're going to do for the purpose of doing these figures is to say, okay, let's assume here we've got no loan. We own a lot free and clear. Maybe we've got a expected project that's $1 million. Just again, use some nice round numbers. And the total loan amount then is going to be 800,000. So we'll plug 800,000 in here for the total loan amount. So that assumes then that if we've got we own a lot free and clear with no loan on it, that maybe that lot is worth 200,000 in this example. So you own it free and clear, there's no loan on it, but it's got a value of 200,000. And so what we're going to look at then is if the loan is going to be for 800,000 to build that home, and there are 8 draws spread across here, 8 draws, how are those funds dispersed over time? So a couple of things that we'll look at here. First off, in this example, you see there are 8 draws here. There could be more, could be fewer. We want to make sure too that as those draw amounts for each different draw, that's going to be based on the contract with your builder. So maybe 15 isn't the first draw. Maybe it's 10 at the first draw, and maybe the next one's 20 based on the particular scenario with your builder. That's fine. We just want to make sure that the total amount for all of these percentages adds up to 100%. So you got to make sure that you're not going over the amount of the loan, that $800,000. So in this example, let's assume, okay, draw 1 is for 10%. That might be a deposit that's paid right at the beginning at closing or something like that. But basically, okay, if we have a 10%, 20%, 10%, 15%, and on different draw percentages, how would my balance grow and how would the payments work on something like that? So in this example, we basically have an $800,000 loan, 4.25% is the interest rate. We know the payments are going to be interest only. So what we're simply saying is, okay, after the first draw, that might be immediately right after closing if it's a deposit of some kind, but whenever that is, essentially a balance of 10% is 80,000, and this would be a rough estimate of the payment if it were based on that amount for 1 month. Similarly, we said, okay, here, if then it grows, another 20% comes out on draw 2. You've got a total loan of 160 now. I'm sorry, an additional 160, a total loan of 240. And if that were a 1 month payment sitting there at 240,000, it's about $850. So the math won't always be exact because there may be some portion of the month your balance was at 80 and then some portion when it moved up to 240. But that's going to give you a ballpark. If that loan balance were 240,000 in this case for an entire month, you'd be about 850 based on this particular interest rate. That process then just repeats. If there are 8 draws in this case, draw 3, draw 4. As you move along, each time the balance is going to grow, that payment's going to increase based on that increased balance until you get to the very end. The last portion is paid out, and then your total balance has finally reached that loan amount of $800,000. So at that point, then is when the loan would convert over, if it's a construction permanent loan, into the permanent phase, and you'd actually start your principal and interest loan repayment. So that actually would be repaying the loan as opposed to having the loan increase. But this first however many months, the draws don't have to be one a month. They can be whenever they're needed for your project. But if you had, for example, an 8-month build with 8 draws and they happen to be one a month, this would give you a very clear example of how those draws would increase your balance over time and your corresponding payment. So we can break that down and do something similar depending on what kind of build you've got, what your project looks like. But that may be helpful in just understanding how draws work, how that balance increases over time. And if you've got questions about how does this work specifically for your build, feel free to reach out to the Kristoff team. We'll be happy to